Hello friends. Welcome to our YouTube channel Vital Knowledge. The first topic that I am discussing about is interest rate. Understanding of interest rate help us in personal finances, investment decision, economic impact and financial planning. So we're going to discuss about interest rate in details. What is interest rate? An interest rate is the cost of borrowing money or the return on investment. It is expressed as a percentage and represents the amount of interest charged or earned over a specific period. Interest rates can be applied to various financial products such as loans, mortgages, savings accounts, bonds, and investments. Let's dive into the details of how interest rates are applied to different financial products. 1. Loans. When you take out a loan, such as a personal loan or a car loan, the lender charges you interest on the amount you borrow. The interest rate is typically expressed as an annual percentage rate, APR. The interest is calculated based on the principal amount borrowed and is added to your monthly payments. The higher the interest rate, the more you will have to pay back over the loan term. Interest rates can be fixed, remain the same throughout the loan term, or variable, fluctuate based on market conditions. 2. Mortgages. A mortgage is a loan used to finance the purchase of a property. Mortgage interest rates have a significant impact on the cost of borrowing. When you secure a mortgage, the lender charges you interest on the loan amount. The interest rate can be fixed or adjustable. Fixed-rate mortgages have a consistent interest rate for the entire loan term, ensuring predictable monthly payments. Adjustable-rate mortgages, ARMs, have an initial fixed rate for a specific period, after which the rate can adjust periodically based on market conditions. 3. Savings accounts. Banks and financial institutions offer savings accounts that allow you to deposit money and earn interest on your savings. The interest rate on savings accounts represents the rate at which your deposited funds will grow over time. It is typically calculated on a daily or monthly basis and added to your account periodically. The interest earned on savings accounts is often lower than other investment options, but it provides a safe and easily accessible place to store your money. 4. Bonds. Bonds are debt instruments issued by governments, municipalities, or corporations to raise funds. When you purchase a bond, you are essentially lending money to the issuer. The bond's interest rate, also known as the coupon rate, is the fixed percentage of the bond's face value that the issuer agrees to pay you as interest income over the bond's term. This interest is typically paid to bondholders semi-annually or annually until the bond matures. Bond prices can fluctuate based on changes in market interest rates. If market interest rates rise, existing bonds with lower interest rates become less attractive, potentially leading to a decline in their market value. 5. Investments. Interest rates have implications for various investment options. For example, certificates of deposit, CDs, are time deposits with fixed interest rates and fixed terms. Higher interest rates on CDs generally mean higher returns for investors. Government bonds, corporate bonds, and other fixed income securities also offer interest payments to investors. Rising interest rates may negatively impact the value of existing bonds, as their fixed interest rates become less attractive compared to newly issued bonds with higher rates. Additionally, stock market performance can be influenced by interest rates, as higher rates can increase borrowing costs for businesses and affect consumer spending patterns. It's important to note that interest rates are influenced by factors such as economic conditions, inflation, central bank policy, and market demand. Therefore, changes in interest rates can impact the affordability of loans, the profitability of investments, and the overall financial landscape. Effects of interest rate changes. 1. Borrowing costs. When interest rates rise, borrowing becomes more expensive. This affects individuals and businesses by increasing the cost of taking out loans or using credit. Higher borrowing costs can discourage borrowing and potentially slow down economic activity. 2. Saving and investment. Interest rates influence saving and investment decisions. When rates are high, individuals are incentivized to save more as they can earn higher returns on their savings. Conversely, when rates are low, saving becomes less attractive, and individuals may opt to invest in riskier assets seeking higher returns. 3. Inflation. Changes in interest rates can impact inflation rates. Higher interest rates can help control inflation by reducing spending. When borrowing becomes more expensive, consumers and businesses may cut back on spending, leading to lower demand and potentially lower inflation. 4. Exchange rates. Interest rate differentials between countries can affect exchange rates. Higher interest rates in one country relative to another can attract foreign investment and strengthen the currency. Conversely, lower interest rates may discourage foreign investment and weaken the currency. Exchange rate fluctuations can impact international trade and competitiveness. Relationship between interest rates and the economy. 1. Monetary policy. Central banks use interest rates as a tool to manage the economy. By adjusting interest rates, central banks can influence borrowing costs, spending levels, and inflation. Lowering interest rates stimulates borrowing and spending, promoting economic growth. Conversely, raising interest rates can curb inflation and reduce borrowing and spending, aiming to stabilize the economy. 2. Economic growth. Interest rates play a significant role in shaping economic growth. Lower interest rates encourage borrowing and investment, stimulating economic activity. They can facilitate business expansion, job creation, and increased consumer spending. Higher interest rates, on the other hand, can constrain borrowing and investment, potentially leading to slower economic growth. 3. Housing market. Changes in interest rates impact mortgage rates, which directly affect the housing market. Lower interest rates make mortgages more affordable, encouraging homebuyers and boosting the real estate sector. Conversely, higher interest rates can increase borrowing costs for homebuyers, reducing affordability and potentially slowing down the housing market. 4. Stock market. Interest rates can influence the cost of capital, which has implications for the stock market. Lower interest rates reduce the cost of borrowing for companies, making it cheaper for them to invest and expand their operations. This can lead to increased corporate profitability and potentially higher stock prices. Conversely, higher interest rates can increase borrowing costs for companies, potentially impacting their profitability and dampening stock market performance. Overall, interest rates have far-reaching effects on borrowing costs, saving and investment decisions, inflation, exchange rates, and various sectors of the economy. The management of interest rates by central banks is indeed a crucial aspect of economic policy aimed at achieving desired economic outcomes. Here's an explanation of why this is the case. 1. Controlling inflation. One of the primary objectives of central banks is to maintain price stability by controlling inflation. By adjusting interest rates, central banks can influence the cost of borrowing and spending in the economy. When inflation is rising above the desired target, central banks may raise interest rates to discourage borrowing and spending, thereby reducing aggregate demand and curbing inflationary pressures. Conversely, when inflation is too low or the economy is experiencing a downturn, central banks can lower interest rates to stimulate borrowing, spending, and investment, boosting economic activity. 2. Managing economic growth. Central banks use interest rate adjustments to manage economic growth and prevent overheating or recession. During periods of sluggish economic growth or recession, central banks lower interest rates to encourage borrowing and investment, which can stimulate economic activity. Lower interest rates make it more affordable for businesses and individuals to borrow, leading to increased spending and investment. Conversely, when the economy is growing too quickly and inflationary pressures are building up, central banks may raise interest rates to moderate borrowing, spending, and investment, aiming to achieve more sustainable economic growth. 3. Influencing exchange rates. Central banks also utilize interest rates to influence exchange rates and maintain external stability. Higher interest rates in a particular country can attract foreign investors seeking higher returns, leading to increased demand for the country's currency and potentially strengthening its value. A stronger currency can benefit importers by making imports cheaper but may harm exporters by making their goods more expensive. Conversely, lower interest rates can decrease the attractiveness of a country's currency, potentially leading to a depreciation that benefits exporters but may increase import costs. Central banks may adjust interest rates to influence the exchange rate to support their desired trade and economic objectives. 4. Financial stability. Interest rates impact financial stability by affecting the cost of borrowing, asset prices, and the behavior of financial institutions. Central banks monitor and adjust interest rates to prevent excessive risk-taking and maintain stability in the financial system. During periods of rapid credit expansion or speculative asset bubbles, central banks may raise interest rates to tighten lending conditions and discourage excessive borrowing and risky investments. Conversely, during times of financial stress or economic downturns, central banks may lower interest rates to provide liquidity and support financial stability. 5. Confidence and expectations. The management of interest rates by central banks plays a crucial role in shaping confidence and expectations in the economy. Market participants, businesses, and consumers closely monitor interest rate decisions and statements from central banks to gauge the future direction of the economy. Central banks communicate their policy intentions to provide clarity and transparency, which helps shape expectations and guide economic behavior. Effective management of interest rates helps foster stability, predictability, and confidence in the economic environment. In summary, the management of interest rates by central banks is a vital tool for economic policy. By adjusting interest rates, central banks can influence borrowing costs, spending, investment, inflation, exchange rates, and financial stability. These actions aim to achieve desired economic outcomes such as stable prices, sustainable growth, and financial resilience, while also providing a framework for economic actors to make informed decisions based on clear expectations. This brings to the end of the video. Do let us know if this video was helpful for you or not, and don't forget to like and subscribe my channel. Thanks.